Good evening and welcome to our performance management class for today. This is part 3 of our variance analysis, standard costing and variance analysis. Before we begin part 3 proper, let's take a review on what we did in part 2. In part 2, we looked at some of the cost variances, and so we did direct material cost variance. Excuse me. We did direct material cost variances, where we saw the total material cost variance formula. Then we saw it being divided into price variance and usage variance, all material price, material usage variance. Then we saw how we derived it, the fixed budgets and the actuals we are given. Then we now saw the flex budget at the middle. And we saw how we can derive our material usage and price variances. Then we now looked at labor variance, the total labor variance. And we said where we derived it was to remove all the Q and the P's and replacing them with H and R. That is all the quantity replaced with R's, all the price we replaced with rates. And we got efficiency and rate variances, which are the sub variance of direct labor. Then we said that we can also get idle time variance. Then we also looked at overhead, total production variable overhead variance. Okay, so we look at the efficiency and expenditure. So this is the same thing as the labor variance, but the only thing different is that we change the rate variance to expenditure variance. And we saw how we can derive that. Then we saw some examples where we solved and we got certain answers which we are building up until now. So today we'll be looking at part 3, which starts with the fixed variance. So this is going to be a different color, but still continue from our page. This is part 3, variance analysis. So we are going to do fixed production overhead variances. Okay, so how do we get that? So let's go back to our material. We're looking at absorption costing. We'll be looking at under and over absorption. We'll be looking at the total fixed production overhead variance, which is broken down into overhead expenditure variance, overhead volume variance, and overhead efficiency and capacity variance. And we look at the possible causes of these variances like we did before. Now, over and under absorption. Variances for fixed production overhead are different from variances for variable cost. By variable cost, what we mean is direct material is a variable cost, direct labor is a variable cost, variable overhead is a variable cost. So Fixed overhead is a kind of different. With standard absorption costing, the standard cost per unit is a full production cost, including an amount absorbed for fixed production overhead. So what we are saying is that whenever we are looking at the standard cost of a product, if you want to look at absorption costing method, all you need to do is when you are bringing the cost of the product, you will need both the standard cost of material, standard cost of labor, standard cost of variable overhead, plus the fixed cost absorbed, standard cost of fixed cost absorbed. Every unit produced is valued at standard cost. This means that production overheads are absorbed into production at number of direct labor hours and a fixed overhead rate per hour. This is okay. I had to settle all the people that are calling my line and they know I'm in a class. All right, so for every cost that you are absorbing, the fixed cost is derived from a standard number of direct labor hours per unit and also something called fixed overhead rates per hour. So we have what they call overhead absorption rate per hour multiplied by the standard hours per unit. That is what we have as the fixed overhead cost, standard fixed overhead cost. So the total fixed overhead cost variance is the total amount of under absorbed or over absorbed overheads, where overhead are absorbed at standard fixed cost per unit. So it means that overhead are going to be the standard overhead cost is going to be done by using standard hours and standard overhead absorption rate. Then you're going to be comparing it to what actually happens. And so you are going to be getting either under absorption or over absorption. I would like you to refer to our absorption costing lecture where you saw over absorption and under absorption, but we are still going to look at it a little. So uh, it was explained in that chapter that the total under or over absorption can be analyzed into expenditure variance and volume variance. We'll be looking at them in a short while. The total volume variance can also be further analyzed into capacity and efficiency. So we have expenditure on the one hand, expenditure on the one hand, and volume on the other hand. And the volume can be divided into two: capacity and efficiency. So we'll look at it now. So look at it. This is the total fixed overhead cost variance. So we have volume variance and expenditure variance. Then we have volume variance and capacity variance. So the way I will do my own now, we'll be doing it somehow a little bit different. Now I want you to look at this. We have variable overhead variance, right? This is total variable overhead variance. And we know we have two. We have expenditure and we have efficiency. Now that's for variable. Now, if you are looking at fixed, so this is total fixed overhead variance. Variances. So I want you to look at it this way. We will still have volume. Look at it as volume. Look at it here as expenditure. Now I want you to look at the similarity and the difference. So in this volume, we will still have efficiency and capacity. So if you look at these two now, expenditure is here, expenditure is here. Efficiency is here, efficiency is still here. The only new thing we are adding here is capacity. So we'll be looking at how they differ from each other so that when you know your variable overhead variance from last week, we can calculate it and derive the formula. You can adapt it to do your fixed overhead variance. That is the essence of this. Now let's go. Total fixed production overhead variance. The total fixed overhead cost variance is the amount of under absorption or over absorption. So first of all, what do we mean by under absorption? Under absorption means, let's say for example, I want to, I'll be spending, um, let's say 15,000 naira for the cost of Zoom license. That is what I budget. So we are looking at budget. That is what I budgeted based on historical um, usage or data. I budgeted 15,000. Now, lo and behold, when I want to pay for Zoom license, I found out that um, it is now 17,000. I budgeted 15 and I'm paying now 17. What it then means is that I have under budgeted based on the current realities. What I have set aside was under absorbed because I have paid 17,000, meaning that what I paid is far more than what I budgeted. So I under budget. That's the way I want to say it. I under provided or I under budget. So I'll use provided. I under provided. So the difference of 2,000 is the under provision or the under absorbed, meaning that the actual realities is higher than my standard. So that's why it is adverse here. Under absorption is adverse. Over absorption, I was thinking it is 15,000 and I now bought it for 14,500. The 500 is a favorable variance to me because what I spent actually was less than what I was budgeting. So I over budgeted. So when you over budgeted in fixed production overhead, you have a favorable variance. When you under absorb, you have an adverse variance. So now let's look at it now. Fixed overhead absorbed in the period. That's what we want to calculate. So this is the actual unit produced. So this is the actual unit produced because we're using a flexed budget, right? Actual units produced multiplied by fixed overhead per unit. So this is the standard cost per unit or the overhead absorption rate. You multiply it with the actual unit produced. You have this is the amount here. Then the actual fixed production incurred in the period. So this is the actual thing you incurred using these actual units. So if this up one here is bigger than the down one here, it means that what you budgeted for is bigger than what you actually spent. It means that you have over absorbed and it's favorable. But if this upper one here is smaller, means you have under absorbed and that is adverse. Now let's look at this question again. This is what we have been doing before. The budgeted production overhead is 2,280,000. That's the budgeted production overhead. This is what was budgeted. Now the budgeted production hours is what has been budgeted. We budgeted production volume, which is 1,200 units, right? This is what we have been doing. Standard hours per unit, we said is 4 hours, right? That means when you multiply these two, you get 4,800 hours. Now, you need to look at the overhead absorption rate. How will you get the overhead absorption rate? You look at the number of hours and the budgeted overhead production, fixed production overhead. So this is the overhead divided by the budgeted level of activity. Budgeted cost divided by budgeted level of activity gives you 600 naira per hour. So it is this 600 naira per hour that is the overhead absorption rate. This is the standard rate to use. So now, for you to get standard fixed cost per unit, you will now say to make 1 unit is 4 hours. Overhead absorption rate for fixed cost is 600, meaning that for every unit, you are spending a fixed cost of 2,400. Now, this is the actual production overhead, 2,500, and that is the actual production, 1,000. You know, you budgeted with 1,200. Everything that you are doing for fixed cost, this is the budgeted figure. This is budgeted. Then that means your overhead absorption rate is derived from budget. Then this standard cost of fixed cost per hour is okay per unit is budgeted. Now we are told to calculate the cost variance, total cost variance for production overhead. So this is how we are going to do it. We have sorry, this is going to be what we are asked to do is total fixed production overhead. So normally in our formula, we usually say it is standard hours, standard rate, right? Let's say minus actual hours, actual rate. Still the same thing we have been doing before. Now your hours, standard hours from this question here, standard hours per unit is 4 hours, right? Which is 4 hours multiplied by actual number of units produced, 1000 units. So 4 hours per unit times 1000 units. Then what is the standard rate? This is the overhead absorption rate, 600. So this is the times 600. So this 600 is overhead absorption rate. This is per hour. All these are the standards. All this refers to the standard. Then the actuals. We were told that your actual overhead production overhead is 2,500,000. That's what we are told. This is 2,500,000. So what do we have here? We will say, let's activate our calculator now. We will say 4 hours times 1000 units multiplied by 600 naira per hour. That gives us 2,400,000. So this is 2,400,000 minus 2,500,000. So the difference here is 100,000. Now, is this adverse or favorable? Now, if you look at it, standard is smaller than adverse, than actual. So what we budgeted for, we spend more. This is adverse. Now, did we over absorb or under absorb? This is under absorption because we budget, or under provision. We under provided. So this is under absorption or under provision. And we said under absorption or provision always give us an adverse variance. So let's see what was done here. That's the same thing. Under absorption. That's the same thing. Now the total of the amount of fixed production overhead rate, sorry, the amount of fixed overhead absorption rate is a function of the budgeted fixed production overhead expenditure and the budgeted production volume. So you see, expenditure and volume. And so the total variance can be divided into um, expenditure variance and volume variance. So a fixed production overhead variance is very easy to calculate. So it is the difference between the budgeted production volume overhead and the actual production overhead expenditure. So you see here, budgeted production overhead minus actual production overhead. So now, this is what I will usually say. Let me break this thing down again. We have standard as sorry, standard as standard rates. Then we have actual as actual rates. That is what we have been having before, right? I want to put something now in the middle. I'll put something here. So this is for fixed overhead variance. I want to put something in the middle, budgeted as, sorry, actual hours, budgeted rates. Actual hours, sorry, should be budgeted hours, standard rates. Budgeted hours, standard rates. So, what it means here is that this should give you expenditure. Like we have here, expenditure when we did very when we did but in the case of so this is actual. Okay, sorry, two we'll be having two things. Sorry, sorry, we'll be having two things. I forgot to put the second one. So normally we will have okay, let's leave it this way. We'll have this here, then we'll have something like this, volume. Later we'll put something here to separate it into efficiency and capacity. So, but let's look at this. Let's look at this example here that we're about to do. We have a budgeted fixed overhead is 2,880. Actual fixed production overhead is 2,500,000. Therefore, the expenditure variance is 300. So this budgeted overhead is just this budgeted hours and standard rate. Of course, budget will come from standard. You are comparing budget and actual. Okay. Now they said fixed overhead expenditure variance can be calculated for control reports for other overheads as well as production overheads. That's not what we want to do now. But let's talk about it. An administrative fixed overhead expenditure variance is the difference between budgeted admin costs and actual fixed admin costs. A sales and distribution fixed overhead expenditure variance is the difference between budgeted and actual. All right, so that fixed overhead volume variance. The fixed overhead volume variance measures the amount of fixed overhead under or over absorbed because of the fact that actual production volume differs from budgeted production volume. Okay, the volume variance is first of all measured in units of output or standard hours. The volume variance in units is converted into money value as appropriate at the fixed overhead costs. Then let's just look at an example to buttress this point. Actual number of units produced, this is what is being produced. Budgeted number of units produced, then we look at the differences. Then that means fixed overhead volume variance in units. Then when you now multiply by the standard rate, so this is actual and budget. Okay, so that's volume variance. So that means we will be looking at um, volume variance here. I think I would need to put something here. Okay, let's continue. We'll bridge that gap later. Fixed overhead production overhead variance. Look at the budgeted production, 2,880,000. Budgeted production hours, as we did before. Overhead absorption rate is this. Standard fixed cost, like we did before, is this. Actual overhead production, everything is still the same. Now we are asked to look for the volume variance. What is the volume variance? Volume variance. So what did we do the last time? Um, Volume variance. Later we amend this my formula here. This is fixed overhead volume variance. We said it's going to be, let's look at this again. Okay, actual number and budgeted. Okay, it's going to be budgeted budgeted hours standard rates minus actual hours actual rates. Okay, so what do we have here? Budgeted number of units, budgeted hours. Budgeted hours, we said it is supposed to be 4 hours per unit, and we budgeted to make 1,200 units. 1,200 units. That's what we budgeted for. It's as good as saying this 4,800 hours is the budgeted hours. Then the budgeted rate is 2,600 naira. So this times 600, this times 600. Then, oh, sorry, actual hours standard rates. Actual hours standard rates. Actual hours standard rates. Actual hours. What we now did here, the actual number of units produced is 1,000 units. So 1,000 now multiplied by 4 times standard rate 600. So let's see, 4 times 1, 2 times 600, because that gives us 2,880. 2,880. Then let's see here, 1,000 times 4 times 600. That gives me 2,400. So when I remove it from 2,880, I'm getting 480 as my favorable variance. 480 favorable. So let's see what we have here. Oh, it's adverse. How did we get that? Oh, to have been interchanged. Sorry, we have interchanged it. So that means we interchange it. So this is actual hours standard rate, budgeted hour standard rate. So we will do the whole thing again. 2880. So we do the whole thing. So this is 1000 times 4 times 600, which will give me 24. While this will give me 2880. This is going to give me adverse. So the only difference here is to make here 200. All right. So that's it. So volume variance. So what I'm going to add here is that pin I wanted to add here. Actual hours standard rate. So that is what we just did now, which is what we just did now. Then we will do something between here and here. I think that should be efficiency. That should be efficiency. We will do all of that. All right. So we'll come back to this practice question. All right. So now that we've seen this as our variance, volume variance, we've seen the formula. We are going to make a list of all the formulas that we have done. Now, a company budgeted to make 5,000 units of a single standard product, but budgeted direct labor hours is 10,000 hours. Budgeted fixed production overhead is 40,000. Actual production in year one was 5,200. Fixed production overhead is 40,000. We are asked to calculate the total production overhead, cost variance, the fixed overhead expenditure variance, and the fixed overhead volume variance for the year. Let's attempt this one. This is practice question 10. The first thing we are asked to calculate the total fixed production overhead cost variance. So A, total fixed cost production. How am I spelling it like this? Production overhead variance. All right, so total fixed overhead variance is equal to, we said, is going to be, from what we did here, standard and actuals. So we are going to be looking at standard as standard rate minus actual as actual rates. So what is our standard? So our standard hours is going to be how many? Budgeted hours. Budgeted hours is different from standard hours. So the actual hours is 5,200 units. It takes us how many? A company decide to make 5,000 units. Okay, this is 5,000 units. Direct labor hours and this. Okay, so how do we get our rates? Our standard rates. First of all, we need to do our standard rates. Let's do standard rates. Standard rates is gotten as the overhead absorption rate, which is going to be what is the standard um, quantity? 500. No, sorry, budgeted amount is 40,000. Budgeted hours is 10,000. So it's going to be you 40,000 divided by 10,000 hours. So that gives you 4 naira an hour. That's the standard hours, standard rates. So the standard hours is 10,000 hours. Okay, so it means that your standard hours standard rate is 10,000 times 4, which is the same thing as that 40,000. That's one. Now, actual hours, actual rate is 40,500. Actual hours, actual rate 40,500. Okay, so it then means that total fixed overhead fixed overhead variance is 40 minus 40,500, which is 500 advance. Then the next thing we are asked to do is the fixed overhead expenditure variance. So the D, fixed overhead expenditure variance. So I'll call it fixed overhead expenditure variance. We said it was this our formula here. Expenditure is going to be budgeted minus actual. It's going to give us budgeted as standard rate minus actual rates. So what's the budgeted as? 100,000. I think I'm still doing the same thing. Still doing the same thing. Just a moment. Let's see how it is being answered yet for the sake of time. Let's see how it is being answered here. So this is illustration 10. Okay, so let's look at what they did here. Standard fixed overhead cost per unit. Okay, what I just did was expenditure variance. What I just did here is expenditure variance. So I will just repeat it. So I'll just do it again, which is the same thing as um 40,500. Okay, sorry, 40,000 minus 40,500, which is 500 adverse. Sometimes this variance could be tricky, but let's see what was done here. Fixed production overhead variance, 5,000 units, 5,200 units was what was budgeted. Let me get a second instance of this so that we can be seeing what it is here. So let's go back to our original question. Okay, so this is the same question we'll be looking out for. Okay, that's it. 5,000 units, but now actual production is 5,002. So 5,002 units. Standard fixed cost is 8 naira. So how did we get the 8 naira? So this is 40,000 divided by 5,000 units. Okay, so that's what we are supposed to do. So I should have come here, standard rate. So this is not overhead absorption rate now. Standard rate. Our standard rate is, what is the um we have how many units here? We have 40,000 is the amount. The total overhead is 40,000 divided by how many units? 5,000 units. So we are looking at standard rate per unit. In the case of budgeted, what we did for budgeted, budget standard rate, which is for budgeted. Here, standard rate is overhead absorption rate. But in this case here, we're not using that overhead absorption rate in this. So this gives us, because 5 times 8 is 40. So this gives us 8 naira. So it means that if you budgeted 40,000 units and 40,000 naira for your overheads, and you're making 5,000 units, that means the standard rate is 8 naira. Okay, that's one. Then, if you're going to be making, so 8 naira per unit, sorry, if you are making 8 naira per unit and you're making 5,200, so it means that 8 naira, this is the standard that you are doing. The standard is what you are doing. The standard rate is 8 naira. Now, applying the standard, whenever you see standard, we need to apply the standard to the actual level of activity. So what we just did now was standard rate. So we'll come back and do your standard hours standard hours is going to be into here. Okay, we understand how to do this. Okay, we're not going to use hours. We're not going to use this hours method. I will still convert it to this hours method later, but now this is the standard rate that you want to do. So if you are producing 5,200 units, you need to multiply it by 8 naira as against how much you spent, 40,500. 40,000, 40,500. So this will give you, for now, let's leave the overhead absorption rate. It's only when we are doing budgeted that we should be using overhead absorption rates. When we're looking at standard, let's do the way I'm showing you here. Overhead absorption rate is normally used for budget. So let's look at this. 8 naira multiplied by 5,200, that gives us 41,600. 41,600 minus 40,500, that should give you 1,100 favorable. I think that's what we got here. The favorable variance is because fixed overhead have been over absorbed. All right, now we got this. Now the next one they ask us to do is volume variance. Let's see if we can use that method. Fixed overhead volume variance. And I said fixed overhead volume variance is use what did I use the other time? Actual hours, budgeted hours. Actual hours standard rate minus budgeted hours standard rate. And the actual hours given to us here was, we're not giving hours, actual hours. We're not giving actual hours here. Actual hours standard rates. So let's not do it that way. That's why the fixed overhead is somehow different. Production in volumes. We budgeted that we are going to make 5,000 units. That's the budgeted volume. The actual volume is 5,000. So, so if you look at budget, actual is higher than the budget. So you can look at it here. Let me change this to actual budget. Actual budget. No, actual units. Actual units minus budget units. So we actually had 5,200 units, but we budgeted 5,000 units. So the difference is 200 and it's favorable. So when the actual is higher than the budget in terms of units, so that's what it is here, 200 units. Now, when you now multiply by the standard cost, still the same thing, still the same thing. So all I would have just done here, let me redo this again. All I would have just done here, instead of using hours, I'll be using units. Actual unit standard rate, budgeted unit standard rate, because it's volume. Actual unit is 5,200. Standard rate, which what we calculated as 8 naira. Budgeted is 5,000 at 8 naira. So what we'll do here is 5,200 multiplied by 8. That gives me 41,600 minus 40,000, which is 1,600 favorable. That's what we got here. So if you look at it now, the total fixed overhead variance is volume plus expenditure. Volume is 16 favorable, expenditure is 500 adverse. So favorable minus adverse should give you 16 minus 500 should give you 1,100 favorable. That's what we got here. 1,100 favorable. So that's for volume. We'll talk much more about that again. Now, fixed overhead efficiency and capacity variance. Efficiency and capacity variance. Any volume variance might be due to two reasons. It might be the company has worked a different number of hours than budgeted, so they have operated at a different capacity because they worked in different number of hours than budgeted. During the working hours, the company has operated at a different level of efficiency than budgeted. So it means that it's either they work a different number of hours than budgeted, then in the number of hours budgeted, they operated a different level of efficiency. Efficiency means like you finish it less than the time, or you do more volume that within that allotted time. So the fixed overhead volume variance can be analyzed into efficiency variance. This is the volume variance here. It can be analyzed into efficiency and capacity. So if you look at it now, they said fixed production efficiency variance. This is exactly the same in hours as the direct labor efficiency variance. So the efficiency variance in direct labor and even that of variable overhead is the same thing for the fixed overhead. Then looking at this example here, standard fixed overhead cost per unit, like we learned before, still this is the actual production in the period, labor hours paid for, labor hours worked. Now the fixed overhead efficiency variances are calculated this way. We use the 1,000 units that we are making. In the standard, if you are to make for 1,000 units, how many hours should we use? Normally we have 4 hours per unit. So if you are making 1,000 units, We are going to be multiplying 4 times 1000, which is 4000. Now, how many hours did we actually work? Which is the number of hours we actually work, 4100. So your standard is more than your actual, and so means you worked more than the hours you worked is more than what was given to you. So that means your 100 difference is adverse because you use more hours than expected. Okay, then look at your standard rates. So the efficiency variance is this. So this is as good as saying this is as good as saying standard hours, standard rate minus actual hours, standard rate. So that's what it's like. That's the efficiency variance, which is what we did when we did variable overhead. Variable overhead efficiency variance. So it's the same thing we did here. Okay. Then fixed overhead capacity variance. This is the difference between the budgeted and actual hours work, excluding idle time. It is converted into money value at the fixed standard overhead rate. So it means here this is the number of hours worked, budgeted hours to be worked, capacity variance in hours multiplied by the overhead absorption rate. So if you look at this here, budgeted fixed overhead is this, production, budgeted production in hours, still the same thing, 48. Look at the overhead absorption rate. Now take note, standard hours is for just setting the standard. Overhead absorption rate is for budget. So that's why person that asks, is there any difference? Normally there should be no material difference. If you have budgeted to make 4,000 units and you have okay, let's say I budgeted to spend 15,000 naira for Zoom, and I budgeted that I'm going to get 100 people. It means that 15,000 divided by 100 is like 150 naira per person. Now, if I am not trying to make what is the standard fixed cost I'm going to charge for 9 people in the class, all I will just do is that 15 multiplied by 9, I'll get my standard cost. But budget is different. You get your budgeted overhead absorption rate. So let me just not talk much about that so that I will not confuse you the more. So but just know that note the way we calculated our budget, production overhead budget. This is the cost we budgeted to spend. This is the budgeted hours. This is the budgeted hours. It may not be the standard hours because this is budgeted units. It's different from the standard units. Standard units need to you take it from actual production. So the difference now is that if I were to look at like the Zoom I used example, I budgeted that the 100 people will come to the class. And that is what I use in calculating the budgeted overhead absorption rate. But in the case of standard, I'm still going to pay that 15,000, right? But how many people are in the class? Let's say 9 or 10 people. I'll just divide it by the 10 and I get maybe 1,500. That's the difference because budgeted is predetermined. Standard here, we'll be looking at the actual production that has occurred. So if you look at this now, standard production overhead is going to be 4 hours times 600, which is the overhead absorption rate we use here because this for budget. Now look at the actual fixed production overhead here is 2,500,000. Actual production is 1,000 naira, 1,000 units. Now number of hours worked said is 141. Budgeted hours to be worked, we saw it here as 48. Then if you minus it, this is the capacity variance in hours. You have to multiply it by the standard. So what it means here is actual hours standard rate minus budgeted hours standard rate. So that's what it means here. Actual hours minus budgeted hours. So what are we doing here? That's the capacity variance. So that's the capacity variance. So this is volume, but this is capacity variance. For volume variance, this is still volume efficiency. This is still volume efficiency. So that's it. Look at practice question 11. A company budgeted to make 5,000 units in a single product in year one. Budgeted direct labor hours are 110,000 hours. Budgeted fixed production overhead is 40,000. In the year one, actual production is 5,200. They worked like see that they put these hours. They worked 10,250 hours. The fixed production overhead was 40,500. Now we are asked to calculate the fixed overhead efficiency, fixed overhead capacity variance. So now let's see how it is being done here. Fixed overhead efficiency variance. Efficiency, let's try it this way. Efficiency, standard hours, standard rate, actual hours, actual rate. Let me see. It's going to work. Okay. So practice question 11. Practice question 11. We are doing fixed overhead efficiency, volume efficiency, volume efficiency variance. Forgive my handwriting. Efficiency variance. And we said is equals to standard hours, standard rate minus actual hours, standard rate. So what is the standard hours? Okay, 500 units, 5,200 units is what we are doing. see here, 5,200 units. So 5,200 units. Okay, so that is what you want to do now. What is the standard standard? Look at what we are going to do. The budget 5,000 units is supposed to take us 10 hours. So standard hours. So what we will do now is standard hours is 10,000 hours divided by 5,000 units. That is the rate we are supposed to do. All the 5,000 units are supposed to take 10,000 hours. You need to know for one. When you do that, you multiply it by the 5,200 that we are supposed to use, we are supposed to carry out. So it means here that 10,000 hours divided by 5,000 units. It means 2 hours is what we can use to take to do 1 unit. And if we did 5,200 units, which is the actual hours, we are going to multiply this by 5,200, which means this is the standard hours that we should use for uh, 5,200 units. So therefore, standard hours, standard rate is going to give us, what is the standard rate? Sorry, the standard rate. We are supposed to look for the standard rate. We have looked at standard hours, standard rate. This is what is budgeted for the whole of 5,000. So it means 40,000 naira divided by 5,000 units. 5 times 8 is 40. So this is the standard rate. So therefore, standard hours, standard rate is 10,400 times 8 naira. 10,400 times 8, that gives you 83,200. Then actual hours, it took them 10,250. Actual hours standard rate 10,250 multiplied by 8. So 10,250 multiplied by 8, that gives me 82,000. So one minusing the other should give me 1,200 variable. So that's what I make a mistake. Oh, I must have made, let's see, 10,400 multiplied by 8, 83,200, 10,250 multiplied by 8 again. So what's the mistake here? Oh, I should have used overhead absorption rate. No? Okay, it's 4 naira. I went to use 8 naira. Sorry, it's a mistake. We're talking about hours. We're talking about hours. For this 10,000 hours, budgeted 40,000 naira. So it's 10,000 hours. So this is 4 naira per hour. It's 4 naira I should have used here. So let's do that again. 10,400 times 4. That will give you 41,600. To be very careful. 41,600. 10,250 times 4. 41. Very careful. This is 41. So it is 600 favorable. You need to be extremely careful. Just as easy as it is to get the marks in variance, it's also easy to mix it up and fail a particular question, but it's not too material. Just a moment. All right, so that's the what we just calculated now is efficiency variance. You just want to calculate it now. Efficiency variance. What's the next one to calculate? And the capacity variance. I will say capacity variance, fixed overhead volume capacity variance. Um, how did we derive it the other time? Okay. Actual and budgeted. So this is fixed overhead volume capacity variance is actual hour standard rate, budgeted hour standard rate. Excuse me. Now, the actual hours here is 10,250. Standard rate is 4 naira. We have it as 41,000 as before. Then the budgeted hours standard rate is, what's the budgeted hours? 5,000, 5,000 hours. So it's going to be 5,000 hours, sorry, 5,000 units. Okay, 10,000 hours. Use the 10,000 hours here. 10,000 hours, 10,000. Hope it's not the same thing we did before. Okay, but not the same. 10,000 hours multiplied by 1 naira. So this will give us 40,000. So the difference here now will be 1,000. favorable. That's what we got here. 1,000 favorable. Now, if you notice the difference here is standard standard hours. We took it from this budget hours and we divide it by the budgeted units to get the standard hours per unit. They will now multiply it by the number of actual hours. That's what gave us this. In the case of this, we would have done the same thing here. This divided by this. But instead of 5,002, we're using 5,000. So it's still the same thing, but the difference here is for budget, it is 5,000. For standard, we're using the actual output. Then we are using that as against what we did here, the number of hours, actual hours. We use standard was 10,000 hours, but actual hours we use 10,250. So some of these things you need to clearly identify them before you can be able to get your answers correctly. So we see here that the snag will be in the fixed costs. So we need to practice that fixed cost a whole well so that now if you look at these two, you want to look at it now. These two, that means your fixed overhead volume variance. It's same thing as efficiency plus capacity. Now your capacity happens to be 100, 1,000, 1,000 favorable, while your efficiency happens to be 600 favorable. So everything is 1,600 favorable. All right. If we were to do it, if we were to do it to check. So let's check fixed overhead volume variance. And we said the other time, volume variance is simply standard budgeted. Standard and budgeted. So let's look at it now. Standard as standard rate, budgeted as standard rate. So our standard hours said is 4 hours. 4 hours. Is it 4 hours? No. Standard hours is 2 hours. Or let's do it this way. When we were deriving this standard hours, okay, it's 2 hours, yeah? So we say this is um, 10,000 hours all over 5,000 units multiplied by 5,200. Then standard rate is 4. All of these minus budgeted hours. Of course, this is 10,000 over 5,000 times 5,000 multiplied by standard rates. Um, let's still use it 4. Sorry, it's not hours. Let's still use it 4. So this is like saying 10,000 divided by 5 will give you 2 times 5, 2. That gives me 10,4 multiplied by 4. That gives me 41,6. 41,6 minus, this is 2 multiplied by 5,000 multiplied by 4. That gives me 40. Minus them together, it gives me 1,600 favorable, which is what we got here. 1,600 favorable. So from what we have just done now, let us bring down our formulas for fixed overhead. So fixed overhead variance. So we have standard as standard rate. We have our actual as actual rate. Okay. Then this is volume. So we will have something here budgeted as standard rate. So we will now have something here actual as standard rate. Actual hour standard rate. So the only thing here, the new foreign thing here we have added here is this. So this is the foreign thing we've added, and we have added it between actual and actual. Okay, so this gives us what? This gives us our expenditure variance. So when we look at expenditure variance, how do we calculate it? Expenditure variance, budgeted, actual. Expenditure variance. So it gives us our expenditure variance. This and this gives us what? It gives us our volume, our capacity variance, actual and standard. This is our capacity variance. Then this and this give us our efficiency variance. So you can see now that this and this give us our volume variance, which is the same thing as this and this. Whereas this and this give us our total fixed overhead variance. So you see here, the thing that we had before, when we had variable overhead, we only had this, this, and this. And we have efficiency at this point between this and this, which is still the same thing. Efficiency is still the same formula. Then we didn't have this, so we had just this and this giving us expenditure. But in the case of fixed, we we now have to add another thing in between these two actuals. So our expenditure stays the same side, but it's going to be between this and this. Our capacity now is now between this one and this here. So capacity now sits in between efficiency and expenditure. So what you should be doing here, if you have a mental picture of your variable overhead variance, so the second to the last item, you just put your budgeted hours. All of them is going to be standard rates, everything. Only this last one must be actual rate. So every rate is standard rate. Just put budgeted hours at the second to the last. Your efficiency stays where it is, expenditure stays where it is, then capacity stays in the middle. So you now look at the two pairs and form your variance. So we can now look at this and we can now say our total fixed overhead variance is standard as standard rate minus actual as actual rate, which is divided into, I'll take this first one, expenditure variance, which is budgeted as standard rate minus actual as actual rate, and volume variance, which is the same thing as standard as standard rate minus budgeted as standard rate. Volume variance is divided, so volume is divided into two: capacity variance, which is actual hours standard rates minus budgeted hours standard rates, and efficiency, which is standard hours standard rates minus actual hours standard rates. So that's the formula. It will take you a while for you to remember this formula, but what I will tell you is try and get this diagram. Once you can get this diagram, you can reproduce the formulas from your head. So what I will tell you to do is take a clean sheet of paper and practice deriving these formulas, starting from your direct cost of material to labor to variable overhead. Then from variable overhead, you now see how you can get your fixed overhead. You can do that several times. Formula will be with you. That's why I had to combine the whiteboard of last class with this so that you see everything in one sitting. Now, what are the possible causes of variances for production overheads? Poor control over spending to give you adverse, or good control over spending will give you favorable variance. Poor budgeting for overspending or overhead spending, sorry, poor budgeting is different from poor control. Poor budgeting, if your budget is not realistic, maybe there are certain things you didn't plan for, you didn't put into consideration, and you now encounter it, that means your budgeting was poor, it was unrealistic. Okay, there will be an expenditure variance due to poor planning. The advanced variance, you see planning variance and you see planning variance. So this is part of that. Unplanned increases or decreases in items, fixed production overhead. For example, increase in rent. Maybe cement is costing far more than what we expected, and we have an unplanned increase in rent. Then fixed overhead volume. We have efficient working by direct labor. So a favorable labor efficiency variance results in favorable fixed overhead efficiency variance. So when we have labor efficiency, labor hours, because fixed overhead is also and variable overhead, they're all linked with labor. So when you have favorable labor efficiency, you will have favorable variable overhead efficiency. You also have variable fixed overhead efficiency. Now, working more hours than budgeted or working less hours than budgeted, unexpected increase or decrease in demand for the product, strike action, extensive breakdown in machines. So all these are possible causes of variances. So now we have been able to reproduce our cost variances. So we know how to produce direct material cost variance, direct labor, variable overhead, fixed overhead. Now let's get into the sales variance. Now the sales variance, unlike cost variance, are not recorded in a standard costing system. They are not recorded in the standard costing system. Normally, standard costs, we have a cost card. But in the case of sales variances, they are included, of course, in our reports to management. So how then do we record the sales variances and how do we use it to reconcile the actual profit with the budgeted profit? Now, there are two variances we will need to calculate for sales. One of them is sales price variance, and the second one is sales volume variance. These are the only two you need to know. And we said before, in cost, if the standard or budget is bigger than the actual, you have a favorable. If the actual is more than the standard and you set, then you have an adverse. But in the case of sales, the opposite is the case. If you budgeted to sell 1,000 goods and you sell 1,200, well, that's favorable for you because you have more revenue. So it's the opposite. So now let's look at this sales price variance. A sales price variance shows the difference between the actual sales price achieved for items that were sold and their standard sales price. So to calculate this variance, you should take into consideration the actual item sold. Now, just the way we do for variance for costs, we look at actual quantity sold or actual hours used. Okay, actual quantity sold. Actual quantity sold. In our calculation, you usually see actual quantity sold when we are looking into the setting the price, the standard. In the case of for price, you look at actual quantity. Sorry, the other one is actual quantity produced. Produced. Now, in the case of sales, we're looking at quantity sold and compare the actual sales with the standard selling price for this. So now let's look at this example here. Standard revenue for actual sales. Look at the actual sales So in the case of sales, the actuals come for the standard for you to get a favorable stuff. This is the standard here. Actual sales quantity multiplied by standard selling price. Actual sales, actual selling price. If this up one is bigger than the lower one, you have adverse. So normally I usually do it this way. So I will come here, sales price variance. Come here, let's say, so what's the topic here? Sales variances. Sales variances. So I will come here, sales variances is divided into sales price variance and the next one, sales volume variance. So you are looking at volume, you are remembering the fixed cost volume variance. So this is sales volume variance. So now in the case of sales price variance, so let's take this one down here. We have actual quantity, actual selling price minus actual quantity standard selling price. I have to put SP again because it's selling price. It's not the same thing as the cost. The other one we say actual price. That one I would have set actual CP, which is cost price. Okay, I can decide to remove the S here, no problem, but we know it's selling price, actual quantity, actual price, standard quantity, standard price. So you see here, the actuals come before the standard. So that's for this. So let's look at an example here. Budgeted sales volume is 1,000 units. Selling price per unit is 15,000. That's the same example we have been doing before. Actual sales unit volume is 900. Actual revenue is this. So now it means that let's calculate the sales price volume. Sales price volume. So what we will do here is actual quantity sold is 900 sold. Actual selling price is, look at the one 12,600, 12,600,000 because this is 12,600,000 is it revenue made divided by 900. If it doesn't give, if it give us a fraction, we'll not write it down. 12,600,000 divided by 900, that's 14,000. So this is your selling price, 14,000. Then your standard selling price, have it as 15,000 according to the question. Okay, so now your sales price, then your sales price variance is actual quantity sold, okay, actual quantity, actual price minus actual quantity standard price. This has the same thing as saying actual quantity here, actual price minus standard price. It's still saying sold 900. This is 14,000 actual. This is 15,000, which is 1,000 difference. 1,000 times 900. 1,000 times 900. That will give you 900,000 adverts. 900,000 adverts. So that's what we are getting here. Sorry, did I do something wrong? Why am I getting it this way? Actual quantity 900, actual selling price. Actual selling price is 15. 15 standard selling price. Actual selling price, because we got it as 14. Okay, it's the same thing. Maybe they didn't put their own in millions. So let me see. 900, 900 times 15,000. 13,500. Okay, sorry. I didn't see these three zeros. So we are in points. We are in line. So 900,000. So that's fine. So that's your sales price variance. So we'll now go to sales volume variance. The sales volume variance shows the effect of profit, the effect on profit, the effect on the profit of the difference between the actual sales volume and the budgeted sales volume. Now, in standard absorption cost system, the sales volume variance might be called a sales volume profit variance. So I'll come here, sales profit, I just say profit variance. So you'll be seeing things like contribution margin here or profit margin here. Now look at it now. This is the budgeted sales volume, actual sales volume, the difference in volume multiplied by profit, standard profit per unit. So look at how we look at it now. Say actual, okay, actual quantity, actual quantity. Now we will not put price now. Actual quantity, standard profit minus standard quantity, or say budgeted quantity, say budgeted quantity, budgeted quantity, standard standard profit. So we can just say here, we can just say standard profit margin multiplied by actual quantity minus budgeted quantity. We just need to remember this one. Actual quantity minus budgeted quantity multiplied by the standard profit margin. So this one has to do with profit, the effect of the profit in the difference in volume. So now let's see this example here. 1,000 units is the budgeted volume. So let's look at this example here. Sales profit volume variance. We will say standard profit margin, actual quantity sold minus budgeted quantity sold. Actual quantity sold is 900, budgeted quantity sold is 1000. What is the standard profit margin? That is what you want to look at. The standard profit margin from your standard cost per unit. Look at your selling price. Selling price was 15,000, standard selling price. So standard profit margin, say standard profit margin is standard selling price minus just standard minus cost price standard, which is your standard selling price is 15,000. Then your cost per unit, standard cost card. Remember when we were looking at part one, remember this standard cost we had. Maybe I should just take us down to part one, where we have that standard cost so that we can refresh our memory. To go further up, come a long way in this variance, so we need to go further up so that we refresh our memory on where this figure is coming from. You see your cost of sales here in the budget. That is your standard cost. So you budgeted to look at it here, budgeted sales of 1,000 units, and you budgeted that your production is going to be 1,2, right? Unlike this one here that we have 900 and 1,000. Look at even at that, cost of sales here is 1,200, 10,200. So it is 15,000 here. That is your budgeted sales minus your cost, and this is your budgeted profits. That is what we are using. That is what we want to derive. So 15,000 minus 10,200. So this is coming from the fixed budget, not even flexed. So if you can see here in the sales, we're not even using we're not using um, the, the flexed here in the sales. In the case of the price, we are looking at actual quantity sold, then the actual price and the standard price. The actual price here is 14, standard price is 15 from the fixed budget. We are not even looking at this flexed budget here. So we are looking at actual quantity, this price versus this sales. This, what is the price here? Of course, from our cost card, this this is flexed price. When we sold actual, it means that if we divide this by 900, our actual price should be giving us 14,000. So this 14,000. Let's just check again. 12,600 divided by 900 course, it's 14,000 we are talking about versus this 15,000 that we sold for 1,000 units. So that's it. Then volume variance. We are looking at actual quantity versus budgeted. I can even say standard. Let me use budgeted, and this is the fixed budget. So 900 was sold, 1,000 was budgeted. Okay, so that's 4,800 is our standard profit. 4,800 is our standard profit. So that's what we'll be using. So we take it down here, 4,800. So that's 4,800 minus 100. So that will give us 480,000 adverts. 480,000 adverts. Okay, so it means that if you were to add these two, sales variance total is going to give us volume plus price. Volume variance is 480 adverts. The price is 900 adverts. So total will give you 1,380,000 adverts. So there is no one formula to get just the total sales variance. You must do these two. You must do them, break them down like this to get the total sales variance. Unlike the other ones where you had to do um, separate. Now let's look at this other one here. A company budgets to sell 7,000 units of a product. It uses a standard absorption costing system. Standard price is 15 naira per unit. Standard cost is 42. So actual sales were 72, which was sold for this. Calculate the sales price variance and sales volume variance. So what we'll do here is practice question 12. Practice question 12. Say sales price variance said is actual quantity, actual price minus standard price. So the quantity sold here 7,200 units. 7,200 units. Actual price happened to be actual price. We are going to divide this by this 351,400. 351,400 divided by 7,200. That's the actual price. Minus what's the standard price? Standard price is 50 naira. 50 naira. So we check here, this is 50 naira. So let's do something here. If I were to divide these two and I get something fraction, I will not do that. If I say 351 400 divided by, oh, sorry, 351 400 divided by 7,200. See, I will not even give my answer like this. So look at another way of doing it. I will now expand the bracket and I will say this multiplied by everything here. So this will cancel this to become 351. 51,400 minus this multiplied by this. So that's the better way of doing it. 7,200 multiplied by 50, that will give you 360. 360. So it's better than to divide this to get a price. Of course, you see that when we divide, you are getting 48 point something something. I don't want that point to make our answer far different. So this is going to be an adverse variance. This is going to be this 351 400. So it gives us 8,600 adverse. 8,600 adverse. So your sales price variance is an adverse. Then we have our sales profit volume variance. And we said it's going to be standard profit margin all over actual quantity minus budgeted quantity. And we know that our sales profit margin is going to be selling price minus standard selling price standard cost price all over actual quantity sold minus budgeted quantity sold. So your standard cost price is 50 and 42. Selling and cost is 50 and 42. So this is 50 minus 42. Actual sold is how many? Sold 7,2. Budget is 7,000. So this is 7,2 minus 7,000. So 42, that is going to be 8. So this is like 8 multiplied by 200 units. So 8 times 2 is 16, 1,600. This 1,600 favorable. This is adverse and this is favorable. So if we are to look at total sales variance, it's going to give us 86 adverse, 86 adverse plus 16 favorable. So the bigger one will minus the smaller one. 86 plus 16. That gives us 7,000 adverse. All right, let's see what was actually done here. 267. Let me say this 290. This question 12. Let's see what question 12 is. 86 and 16. Exactly what we said. All right. Possible causes. Possible causes include price variance, sales price variance, actual increase in sales price higher than what was expected due to market conditions. And we also see that actual sales price less than standard because major customers were giving unplanned discount. Then competitors reduce their price and it forced the company to reduce its own price. What about volume? Actual sales demand were more than or less than expected. The sales workforce worked well and achieved more sales than budgeted. Then when you do advert and you have more people converting, all your leads are being converted into sales and have more success. Then, for example, also a competitor went into liquidation and so they were not in the market again, and all their customers now comes to yours to have increase in sales. Or maybe product that the company is making goes out of fashion earlier than expected, so your sales volume reduce. Now that we've seen all of this, now let us see the interrelationship between the variance. Let's see the interrelationship. We are getting somewhere. Now we said some causes of individual variances has been listed already, and the reasons for some of the variances can be interconnected, and two or more variances may come from the same source. And so this is known as interrelationship between the variance. Now look at one. One variance might be favorable and another variance might be adverse. Taking each variance separately, the favorable variance might suggest good performance and the adverse variance might suggest bad performance. However, the two variances might be interrelated and the favorable variance and the adverse variance might have the same cause. So when this happens, management should look at the two variances together to assess their significance and see the control that needs to be taken. Now let's look at sales price and sales volume. A favorable sales price variance and an adverse sales volume variance might have the same cause. If a company increase its selling price above the standard price, of course, the price variance will be favorable. But because your price has gone up, your volume of sales will come down. So the economy says the higher the price, the lower the demand. The higher the demand, the lower the price, or the lower the demand, the higher the price. And so they are inversely related. So if your price is high, there's a tendency your volume will be low. Similarly, in order to sell more product, a company might decide to reduce its selling price. So you lower your selling price and you get a sales advert selling price variance to be adverse. But that will not give you a favorable sales volume. Now look at material price and material usage. I said that before when we are saying material price and usage. A material price variance and usage variance might be interrelated. For example, if a company decides to use a material that is more expensive than the standard, of course, the price variance will be higher, which is adverse, but it will go into better quality. Wastage will be reduced, so it will become the usage variance will be better. Or if a company decide to use substandard and they bought it at a cheap price, the production manager bought it at a good price, cheap, lower quality will lead to high wastage. And you see, both of them are related. Now look at labor rates and labor efficiency. Now, if you use a high grade labor to do something, you're willing to pay well. Your labor rate variance will be high, meanwhile your efficiency variance will be high. So labor rate variance is high, adverse. Efficiency variance high, favorable. But when you are using lower grade, just want to get cheap labor, you don't have the money to pay for quality. You spend a lot of hours trying to correct, trying to supervise. Your efficiency will be high, and be low, which is a adverse variance. Meanwhile, your rate variance is low, which is a good thing. So they are opposite. And so management will now look at these variances as they are affecting each other. What is the overall effect of the two of them acting together? Then labor rate and variable overhead efficiency, same thing, capacity and efficiency. So this is interrelationship between the variances. So now we come to the actual reason why we are doing this variance, reconciliation of actual profits, budgeted and actual profit, which is the standard absorption costing. All right. The purpose of an operating statement, we need to show an operating statement. A management report is also called an operating statement. This report shows how the differences, it shows the differences between the budgeted items and the actual items, especially the budgeted profit and the actual profit. It shows the difference between them and how these profits have been reconciled using all the variances. So the purpose of an operating statement is to report all variances to management and show how they have an effect on the profits. Now look at the format for an operating statement. So we will look at the Lagos management statement. We start with budgeted profit because that's what we did first. Standard profit. So we always start with standard profit, and it will make us to derive the actual profit. So now let's start. Your budgeted profit is first brought. Say profit as per budget. After doing budgeted profit, the next thing to do is your sales variances first. Have your price variance. Remember, we have 900. Let's see, we had 900, 900 adverse. The other one is 480 adverse. So we bring them together. Adverse are being deducted from this profit because the way we did it, all our adverse are well, so if you're starting with budgeted profits, all your adverse are to be subtracted and all your favorable are to be added. So when you subtract these two from this 4.8 and you get this, then you bring down all your cost variances. You separate them together, you separate them, all your favorable variance on one side, all your adverse variance on the other side. Some people can decide to put all of them together. So if that's the case, anyone that is favorable, put them straightforward. The one that is adverse, put them in brackets. But it's good to put all your favorable one side, adverse the other side. So your direct material is showing you favorable price, favorable usage. So you see there was no interrelationship. Direct labor rate and efficiency, they are all adverse. Then we have idle time, which we calculated the other time. Variable overhead expenditure, okay, variable production overhead expenditure is adverse, efficiency is also adverse. Then the fixed overhead expenditure is favorable. Most of these things are adverse. Production overhead efficiency, fixed overhead production capacity. So you see here, expenditure, efficiency, and capacity, three of them has been broken down. So you break them down to their various components. And all the favorable variants are done here, all the adverse variants are done here, because this will be negative, this is positive. So this 772 minus 746 will give us 26 here. It's favorable because the resultant, one that is bigger, it was followed. The favorable is bigger than the adverse. add this favorable down to this figure, add it, then you have your 3446. And that's the actual profit that we um, reconcile. Let's go back to 270. Let's see. 250. Let's go up to see how we are able to. All right. So this how we got from here, which is from the 48 down to this figure. So you see how it is being reconciled. You reconcile your fixed budget with your actual, but you only use your flexible budget to show those cost variances. To show those cost variances. The flexible budget shows the cost variances, whereas the sales variance shows the difference in volume and the effect on profit. So this is how it gives us the actual profit. So we are going to be looking at a full question maybe the next time where this is done. Reconcile a budget question. Maybe use a past question to do that. Then we have a note here. Other overhead expenditure variances, assuming administrative expenditure, overhead, sales and distribution overhead are fixed costs. So administrative overhead, selling and distribution, they are all assumed to be fixed costs. Are the differences between budgeted other overheads and actual other overheads. In the absorption, in the system of absorption costing, operating statement begins with the budgeted profit. As I showed you before, it starts with the budgeted profit. If you start with the actual profit, it means that you are going to be doing certain things opposite. It means if you start with actual profit, you are going to be adding all the adverses and lessen all the favorable. Okay, so variances, okay, these are exactly what I just said. All right, so we begin with the budget profit, then the sales variances are shown next. Okay, the resulting figure is a subtotal, then the cost variances are listed next. All right, any favorable, they have separate columns for favorable, separate column for adverse, right? So then we will now have the actual profits when everything is being reconciled. So it must tally with what you have in your actual statement. Now, standard marginal costing. So what we used before was absorption costing. What is it? Standard absorption costing. Now this is standard marginal costing, where we have contribution and all that. Now, the Lagos example we used was based on standard total absorption costing. And what if we were to use standard marginal costing instead? So it means that your closing stock is valued at variable cost of production. You know, the last time we use um, our closing stock was total cost, which include fixed costs and it is standard. But this time around, we're not going to be using fixed costs. We're going to be using only variable production costs and not standard full production cost. So that 10,200 we got will not be our cost of sales. We'll be using marginal cost of sales. That one was total cost of sales. And so this means that our budgeted profit will be different from what we have in total absorption costing. Most times in your exam, you will see absorption costing mainly used. Marginal cost variances are calculated exactly the same, but with two important differences. Sales volume is expressed as a monetary amount by multiplying with the standard contribution margin. So that time we said standard profit margin, change it to standard contribution margin, which means it is sales minus variable cost. And there will be no fixed overhead volume. There will be no fixed overhead volume variance. Fixed overhead volume variance will no longer be. It's just be expenditure and efficiency. Fixed overhead volume variance will be zero. All right. So look at it now. Direct materials we have 5,000. Direct labor 2,000. Variable overhead 800 as we got before. Our marginal cost of production is 7,800. Remember it was 10,200 before because of the fixed cost. So if that's the case, this is the flexed budget. That the flex budget here. So look at our sales price as before, our costs, material cost, labor cost as before, variable overhead as before. But take note there is no fixed overhead at this point. So when you add all these variable costs, it gives you 9,360. Now, your closing inventory. How is your closing inventory valued? Your closing inventory is valued at 7,800. It is this 7,800 you calculated 5,200 and 800. 5,200, 800. These are the cost per unit. So it's valued at material. One unit costs this, 1 unit of labor costs this, 1 unit of variable overhead costs this. So that is the closing stock you are valuing. The remaining 200 you didn't sell. So the closing stock is valued at this. Deduct it from variable overhead. Okay. So this is your cost. This is your cost of sales. So this is your cost of sales. So this is your closing stock. So this is your cost of sales here. You have to minus this cost of sales from sales. This is supposed to be your contribution. 7,200 is your contribution. This is your marginal cost of sales. It's like your variable cost of sales here. All this is your variable cost. This is your variable closing stock. This is your variable cost of sales. And this is your contribution, 7,200. Now, if you are to bring your fixed cost is 12,880. Then your profit is 4,380. So 4,000, 4,320. That's the same 4,320 we have here. But you see here, everything was done in such a way that look at it now. Your fixed cost here was 24. Here, the fixed cost was 2880. Everything was the same except your closing stock, which was 10.2 here. Sorry, it was 10.2 here. This is your flex budget here. Your flex budget 15,000, 1,000 units. Yes, it's the same thing. So your fixed cost, your closing stock is different. Every other thing is the same. Every other thing is the same. This here is the same here. Every other thing is the same. Your fixed cost is the same. So this is your budget. This is this one that they did here, your standard budget. Okay, okay. It's the same thing. And this budget is the same. It's the same budget here. But now you see here that it is flexed. It is still flexed. You can see that in the cost, all the cost happens to be the same up to here. Because unit was 1,200. Okay, but how many was actually sold? It's 100, 1,000. So so it is like this here. It's still the same thing here, but here your closing stock happen to be different from this because of the marginal costing style that is being used. Okay, and so your cost of sales reflects 1,000 units. Now your fixed overhead, you're using 2,880. Now, if we are using 2,880, it is still the same thing here because fixed overhead is still the same amount per unit, whether you are using 1,000 production, 900, so it's still the same thing. So you can see here that the budgeted profit is still the same thing with this flexed budget. So you see all the costs are the same here because of the production, but because we have 200 that was not sold, we calculated and found our, excuse me, found our closing stock, which is materially different because we use a different style. Don't worry, when we start solving a question, you will understand that very well. And you have your fixed budget for the period, budgeted contribution. You have 1,000 units. 15, 15 was the selling price. 15, okay, you can still look at it up here. 15 was the selling price of the sales. 15 was the selling price, yes. 7,800 was the cost, variable cost. And so your contribution is 7.2. And when you bring your fixed production cost, it's still the same thing that it gives us. Now, okay, sorry, this was supposed to be fixed. Yes, fixed. I don't know why I was calling it flexed. I look at flexed, the same thing we try to achieve, but now this is adjusted to unit of production 1,000. So the same as before. Now, can you see now that your cost happens to be 7.8 here because you made unit production of 1,000 units. Now, your cost happens to be this variable cost. Your closing stock, I said, is valued at 7,800. So that's how you got this. That's how you got this. Okay, and we said closing stock is always at standard. The cost of sales happen to be this. This is your variable cost of sales. And this should give you contribution course, the fixed budget will not have contribution. This is contribution, contribution. Of course, we can put contribution if you want to. Then the fixed budget overhead 28, 24, 25, 28, 24, 2880, the same thing, just that the closing stock differs. So note that the actual closing inventory of 100 units is measured at the standard marginal production cost of 7,800. That is what happens when we're using standard costing system. Always note that your closing stock is standard cost. So if it is total cost, add all your variable cost and your fixed cost standard and get that standard cost, and you use it to evaluate your closing stock. If it is marginal cost, find it at the standard marginal cost. Then standard marginal costing variances. All variable cost variances are the same. All variable cost variances are the same under standard and marginal costing system. They are all the same. All the cost variances, all the variable costs, direct material, direct labor, variable overhead, these three are the same. Then sales price variance is the same. Now the difference is only the fixed production overhead expenditure variance is relevant. Expenditure variance is relevant. Then there is no fixed overhead volume variance. So that volume variance that have capacity and expend and efficiency will be all out. Only the expenditure variance is relevant. Then sales volume variance. Sales volume variance shows the effect of contribution on contribution of the difference between the actual sales and volume. Unlike the other one that shows the effect on profit, this one shows the effect on contribution. So that's it. So if you look at this example here, budgeted sales volume is 1,000, budgeted selling price is 15, budgeted cost per unit is 7,800. Of course, the contribution is 7,002, as I said before. Now the sales volume variance, I said is actual variance, actual volume minus budgeted volume multiplied by the contribution. So we have 900. So it's just like saying 900 is the actual, budgeted is the 1,000. What is your contribution margin? It's 7,200. So that's going to give you minus 100 times 7,200. That's going to give you 720. So this is going to be 720 advance. Because it's a minus. That's what we got here. So we're just doing sales volume variance here. Then when we look at the operating statement, it is still the same thing. Start with budgeted contribution. The other one, it was budgeted profits, but this is budgeted contribution. Look at the sales variance, the sales volume variance, and we've got a subtotal. Then you need to bring all your cost variance, favorable and adverse differently. And we see that overhead and overhead fixed overhead efficiency variance is not volume variance is not there. If you want to put it, you can put zero. because it will be missing. It will give you zero. And so the actual profit now happens to be this. So that way it has been reconciled using the standard marginal costing. All right, so all these ratios here, I've not seen them use them in questions on variances. So I would like you to look at them at your own time and see how you can bridge the gap. Suffice it to say, we have covered basic variances. In our part 3, we've covered basic variances. So we've looked at standard cost, and we have seen example of standard cost. We have seen how to construct a flex budget. Then we saw how we can calculate our variances, all our variable variable cost variances, fixed cost variance, and sales variances. We've seen how we are dividing them into their subunits. Then we now saw how to prepare operating statements and to reconcile budgeted profit with actual profit using the total absorption costing, and to reconcile uh, the budgeted contribution with actual contribution using marginal costing. So in our next class, we'll be spending time solving past question on basic variances that we have just learned. Then after that, we'll be entering into something called advanced variance. So after solving some past question on basic variance and we get the hang of it, we will now enter into advanced variance and see how we can move our knowledge a step further to handle the advanced variance that will occur. So please prepare your mind to solve plenty past questions. Now, for now, let's see some of the questions might want to solve. So let's use that. Uh, let's see some of the questions you may want to solve. Let's see. Let me open some of the questions you may want to refer to. Okay. So let's see if there's variance here. Standard cost and variance analysis. Why is something blocking here? Okay. So this is I'll call this one A23. Let me put it in a different color here. Put it in black. This is A23. You'll be able to look at this. This is another A23. This is another one, A23. Once again, this is A23. This is another one here, A23. Of course, this is not this variance, but this advanced variance. It's another one, A23. So we'll be looking at some of these questions and see how we can solve a few of them before entering into the advanced variants. So these are some of the things we'll be doing next week. Okay, so thank you so much for the time spent in this class and for giving me your attention. I want to wish you a very, very good night as we review this, um, to review what we've learned today and see how we can try our hands on this question I've marked so that when I will be solving them, it will not look too strange for us. Thank you so much and see you in the next class.